Hi there, welcome back. You're still watching Market Fatafat on ET now. Thank you so much for staying tuned. Let's now bring on board Arpit Beriwal, the manager of derivatives analyst, equity research at Motilal Oswal Financial Services on the technicals, and Jana is joining us once again on the research. Arpit, thanks so much for taking the time out and joining us today. Let's come straight to you. Your first stock that you've picked out for us on the charts is HCL Tech. Now, a lot of analysts are actually picking out this stock. Tell us, what's your view on the charts when it comes to this, and how much further momentum, if any at all, are you spotting for this stock?
Yeah, very good afternoon, everyone. So, if we talk about, as we're speaking about the IT stock, and if you're seeing overall, the market has been in totally carnage space. But if you see overall defensive sectors such as IT index and pharma index are relatively better. Within the IT space, HCL Tech has been a huge outperformer. So, if you see on the monthly scale, it is trading a life high territory. On the weekly scale, it gave a range breakout above 1800 levels, and in spite of market weakness across all the indices, it is holding well above 1800 1820 zones. On the daily scale, it is trading more or less in a trading band between 1810 to 1870 1880 levels, but in spite of market weakness, it is holding strong. So on all time frames, it is holding very strong, and slowly steadily as market recovers, definitely you can see a good up move towards 1920 1950 zones in this space, in this counter. So we'll be this would be a top pick within the IT pack, with keeping stop loss of 1780 for an upside move towards 1920 and then 1940 levels.
All right, that is HCL Tech on the charts. But moving on to Piramal Pharma, that is in focus today on the back of a brokerage note coming in by Jefferies. In fact, they are maintaining a buy on the counter with a target price of 260 rupees per share. Despite a positive note coming in, Piramal Pharma is mirroring the market, is trading with cuts of more than 4.5% right now. But favorable phasing orders in the CDMO has driven the quarter two beat. We saw good set of numbers coming in for Piramal Pharma, at least especially in the CDMO part of their business. The CDMO still maintains the growth momentum going ahead, and management has also reiterated its FY25 revenue and EBITDA growth guidance of low teens. For FY25 to 26, EBITDA estimates they have increased by 2 to 3%. And on the back of that, a positive note coming in by Jefferies, they're maintaining a buy on Piramal Pharma. But nonetheless, Piramal Pharma is reeling under selling pressure, trading with cuts of 4.6% right now.
Well, absolutely. But if you take a look at the pharma segment overall, it's been quite an outperformer if you take a look at it on a long-term time frame. And here's an excerpt from the chat ET Now's managing editor Nikunj Dalmia had with market veteran Madhu Kela, who has been bullish over the pharma space. He also believes that the CDMO players are the outliers in the pack, and it could be a 10-year growth opportunity. Let's go across and listen into what he's making of the pharma pack going ahead, and what is he particularly liking about the CDMO space.
This is a bottom-up sector. You have to कितने सारे शेयर निकुंज 4 गुना हुए हैं फार्मा में in last 2 years.
ग्लेनमार्क हुआ है, लॉरिस बढ़ा है, शायद वोकार्ड बढ़ा है, जहाँ तक मैं याद कर रहा हूँ.
वोकार्ड बढ़ा है, स्टाइड्स बढ़ा है, 4 गुना हुए हैं, मैं बता रहा हूँ. From अगर कोविड बॉटम से देखोगे तो कई शेयर 5 गुना हुए. It's been a very good run.
बस सब थीम्स फार्मा में CDMO, जेनेरिक.
एक जो बड़ा थीम है, which is from a 10-year perspective, it is CDMO.
अच्छा, CDMO क्या होता है?
तो निकुंज, ये जो पहले क्या है, कोई भी फॉरेन की जो कंपनी होती है, राइट, जैसे मर्क है, ग्लैक्सो है, दे आर एक्चुअली आउटसोर्सिंग ईदर कॉन्ट्रैक्ट रिसर्च और आउटसोर्सिंग सम मैन्युफैक्चरिंग टू इंडियन कंपनी. So because of the geopolitical situation between America and China, a lot of the work which was going to very large Chinese companies and which are multi-billion-dollar companies, which have even better capability, better infrastructure, no doubt. But because of this geopolitical reason, that work is shifting. Now where can it shift? It's not it can shift to Mexico, it's not it can shift to Taiwan. वहाँ पे capability नहीं है, right? इंडिया में capability है, अपने पास infrastructure है, technical talent है. तो वो जो shifting है ना निकुंज, वो 2 साल से चालू हुआ है. It's not yet visible in number.
Okay, well, on that note, let's move on. Talk about ITC, because that's also been an earnings candidate yesterday. Numbers trickled in late last evening, and if you take a look at what these numbers look like, it's been a rather mixed set coming in for ITC, but the stock is managing to hold on with 2% gains in today's trade. If you take a look at what the scorecard looks like, it's been a beat on the revenue front. Revenues come in at 19,328 crores, which is 13.5%, 13.7% uptick on a year-on-year basis. So that's a beat coming in versus our expectations. PAT and EBITDA have come in line with what we were expecting. EBITDA is up 3.3%, PAT is up 0.6%. However, margins have come slightly under pressure, coming in at 32.8% compared to 37% last year, and our poll of 35.6%. So it's a beat coming in on the margin. So overall, a mixed set of numbers coming in. The FMCG revenue has seen a 6% growth, and we were expecting 6.5%, so largely in line. Cigarettes business, the net segment revenue is up 7.3% here on. Even when you take a look at hotels, the segment revenue is up 12.1% compared to our poll of 10%. So a good beat coming in on the hotels front as well. Agri also seems to have done pretty well for itself, because segment revenue is up 47%, led by the leaf tobacco and value added products. If you take a look at paperboard business, this is slightly under pressure this time, but it has still managed to beat our estimates. And if you just quickly take a look at what the brokerages are saying, we'll just bring that brokerage note for you. You have Goldman Sachs on ITC. They've maintained a buy rating of the target price to 525 rupees from 515 earlier. So that's a roundup on ITC, largely mixed set of numbers.
All right, we are getting in the numbers for JSW Steel. We see the PAT is at 438 crores versus last year. We had, the PAT had come in. In fact, it's a beat coming in on PAT and EBITDA, both of them. In fact, it's a beat on all accounts as far as JSW Steel is concerned. EBITDA is at 5,437 versus each now's poll of 4,642 crores. We can see the margins have come in at 13.7% versus each now poll of 11.2%. So beat coming in on the margin front as well. Also on the PAT front, PAT has come in at 439 crores versus each now poll of 371 crores, which is again a beat. So all in all, as we can see the first snapshot of the numbers, JSW is giving a beat on all accounts as far as ET now polls are concerned. So that's where the numbers are for JSW Steel are at. But we will, going forward, as and when more numbers trickle in, we'll get you the update for that. But let's look at how the stock price is also reacting. If you can pull up the chart for JSW Steel right now, yes, there is a sharp uptick that's coming in. In fact, as you can see, that spike up that has come in after the results have, just come in. And as far as ET now is concerned, it's a beat coming in on JSW Steel. But we'll get you more update once we start getting more information on it. But let's move on to IndusInd Bank. Now, this counter is, Jenna, it's completely badly taking it on the chin, a free fall that's happening in IndusInd Bank, trading with heavy cuts and heavy volumes at that. Tell us a bad set of quarter two results. Tell us what do the results look like.
Definitely IndusInd Bank, one of the top losers. Actually, we did saw a 20% down circuit as well. If you look at the earnings fine print, a total miss on every account, but mainly if you look at the NII, then it missed about the estimates by 4%. The PAT was down significantly, 38%, coming in at 1,325 crores. Now the main reason behind this was the bank made a contingent provisions of 525 crores this quarter, and this was mainly due to the distress in their MFI segment, and that is why we are seeing a significant downtick across markets for IndusInd Bank. Also, with brokerages note, if you talk about Investec, they're maintaining hold rating and have cut the target price to 1,410. What they call this is a kitchen sinking ahead of a CEO decision by RBI. They say that it will take a few more quarters before fundamentally bank improves. We also have a note by Nomura, who are maintaining neutral rating and have cut the target price to 1220. Definitely they say that it's a weak quarter, challenging outlook for near term as the triggers are absent amid the challenging asset quality outlook.
Okay, but before we move on and listen into what the management of IndusInd Bank also had to say, let's just quickly revisit the JSW Steel numbers once more. We have more numbers trickling in. It's been a beat on PAT this time, like Ankita mentioned, but this is also taking into account that there's been an exceptional loss of 342 crores. Despite this, there is a beat coming in on the PAT, which means it's a very strong and solid set of numbers coming in for JSW Steel. Also, we now have the standalone EBITDA per ton figure that's coming at 8,756 crores per ton compared to 8,398 crores per ton on a sequential basis. What we were penciling in is at 7,500 per ton, which means even the EBITDA per ton is beating what we were expecting here and what the street was overall expecting. So some recovery being seen on the stock. If we could just have the chart back up on screen, you'll be able to see that the stock is recovering. That stock was also not doing pretty well in today's trading session, but a slight uptick coming in on the stock from almost the lowest levels of the day. But on that note, let's move on. Let's go across and listen into what the management of IndusInd Bank also had to say. You have Sumant Katpalia, the MD and CEO of IndusInd Bank, who joined us earlier in the day and spoke about funding and lending cycle. He says that these will be key monitorables as far as the stress in the MFI segment is concerned. Let's go across and listen to what he had to say.
I think the microfinance recovery is the fastest. During COVID also, it was the fastest recovery. We must watch out for two things. The thing to watch out is on the microfinance, A, is the funding happening and is the lending cycle improving? I can tell you in October, the lending cycle has improved. The loan disbursement process, we were doing 100 crores a day and now at 180 crores a day. So what we did in the whole of Q3 was about 7,000 crores. We're already seeing a 60 to 70% upside on that number already on the disbursement which we've seen in the first 15 days. So that's very, very important. Number two, how many centers of yours are functioning and are viable? I think our 80 to 85% of our centers are viable and they are functioning at an efficiency of 100% almost. So that's a very, very important parameter in a microfinance. Third, I think I've always believed that in good times you make provisions and in bad times you take out provisions to manage your credit flows. In my opinion, even if the provision is a higher, we have enough buffers in our balance sheet to take care of it. So the disbursements are coming back. We have enough provisions in our balance sheet to take care of any downside. We are well fortified to take care of the growth as we go forward.
All right, moving on from IndusInd Bank to MCX. Arpit, you picked out MCX for us. This counter has given some really good returns in the last 6 months. In fact, last 1 month also it has moved up some 11% odd. Tell us what's the upside it is. Is the stock heading towards this 52-week high now?
Yeah, so if you talk about over the exchanges space, so we have seen a stupendous rally in this counter, whether it's MCX or BSE. And comparatively, if you see the MCX chart structure, in the last couple of months, it's seen a good rally from 5,500 levels to 6,000 and then 6,500 levels. If you see on the daily scale, the stock is consolidated in a high band, mainly due to the broader market weakness. We have seen decent correction in mid-cap and small-cap stocks, but still MCX is holding well above its major support zone, that is 6,200 zones. So the base of the stock has shifted higher. And if you see the base of the stock moved from 5,500 to 6,000 and now the new base is around 6,200. So on the weekly scale, till that stock holds above 6,200 zones, slowly steadily as the market recovers, definitely we can see new life highs towards 6,700, 6,800 zones. So overall from a strength wise, the stock is in quite strong uptrend. Minor dip towards 6,350, 6,400 would be a good entry point, with keeping stop loss of 6,200 for an upside move towards 6,750 and then 6,900 levels.
Okay, on that note, we'll slip into a very short break on this edition of Market Fatafat. Keep it going with all the buzzing stocks on the fundamentals and on the charts on the other side of this break, so you stay tuned. Hi there, welcome back. Thanks so much for staying tuned. Arpit, I'm going to come to you for your technical check on Coforge. If I pull up the charts for Coforge, last 1 year the stock is up 57%, 6 months also similar, YTD up 25%. Tell us, what are you spotting on the charts for Coforge and what are the next levels that you are keeping in mind?
Yeah. So if you see overall the market breadth has been quite under pressure. But if you see overall, as you are quite bullish on the IT pack, IT index has been the defensive sector, and especially the mid-cap stocks has strong outperformance in this market weakness also. So Coforge is a top pick within the mid-cap IT pack. If you see technically, the stock is trading at life high territories. On the monthly scale, the structure is of higher lows is intact. On weekly scale, post the outcome of result, it has seen a huge uptick of almost 10 to 15%. And now also, in spite of market weakness, the stock is trading at life highs and holding well above its previous supply zone, that is around 7,350, 7,400 zones. So all in all, on daily frame, till it holds above 7,350, 700, 400 zones, it is likely to scale new record highs towards 8,000, 8,200 plus zones. So within the mid-cap IT pack, Coforge would be a top pick. One can go long at current levels or minor dip in between 7,650 with keeping stop loss of 7,350 for an upside move towards 8,000 and then 8,200 zones.
Right, Arpit, you've also picked up Max Financial for us. Now, as I can see on the charts, in the last 2 days, in fact, the stock has really ticked up. In fact, it's ticked up 8% in the last 2 days. Tell us, what are you seeing more upside on this?
Yeah. So if you see overall, apart from these counters, a lot of counters have seen a good rally. If you talk about the financial space has been very selective. Today we have seen a deep cut in financial counters, but if you see overall last 15 days, the financial stocks have been holding well. If you talk about Max Financial, the chart structure is very strong. On monthly scale, it is forming higher lows. On weekly scale, it has given a range breakout about 1220 levels, and on a daily scale, couple of days back we have seen a sharp uptick above 1220 levels, and it is holding well above around 1220 1240 zones with good surge in volume. So I think within the financial pack, technically the stock is quite in strong uptrend, and definitely we can see a good rally of 8 to 7 to 8% from current zones also towards 1320 1350 levels. So Max Financial would be a preferred pick within the financial pack. With keeping stop loss of 1200, one can go long at current levels for an upside move towards 1320 1340 levels.
Max Financial is Arpit's preferred pick in the financial space. But on that note, Arpit, we'll have to let you go. Thank you so much for joining us, as well as Jinay and Nilesh in the previous segment. Thank you so much for joining us, gentlemen. But on that note, let's before we wind down on this edition of the show, let's go across and listen into something. We have a special feature. In fact, it's the day 2 of the Ultimate Pickleball Showdown at the PWR Duper India Masters. Let's tune into some live action from the event. Getting you all the action on ground from that pickleball event, but the Indian capital markets have seen a tremendous boom in retail participation and SIPs over the last couple of years. With India heading towards a $5 trillion economy, will the capital markets mirror India's growth trajectory? Will the financialization of savings drive retail investments? Nikunj Dalmia caught up with HDFC AMC's Navneet Munot to understand what's next for the entire mutual fund industry. Let's go across and listen into a slice of this very interesting exclusive conversation.
Capital markets are likely to grow tremendously over the next several years. We have seen the growth, sharp growth in last few years, but this is just beginning. There would be cycles in markets. That was the cyclical part of it, but the structural growth story has just started. I think we can go back and see what happened in United States from 1980s onwards. The growth of capital markets, the growth of the asset management industry and the wealth management. Something similar is likely to happen in next 30, 40 years. Our size is today same as what, let's say, Capital International or Fidelity had in 1980, and you can see their assets under management today. And people say, which segment? I said, everything will grow. Active funds will grow, passive funds will grow, PMS will grow, alternatives will grow. Everything will grow, because we are at a time when we are going to see this economy transforming from 4 trillion to 15, 20, 30 trillion dollars, when per capita GDP from $2,500 will go up many-fold. I think this is one part of the economy where people will have more investable surplus, people will have to take care of their retirement, and they will come to the markets.
You know, with the mutual fund CEO, we've always asked about returns, which is what is equity return? And the answer is that GDP, nominal GDP plus 2%, risk-free return plus 5%. What is the hurdle rate for, let's say, an HDFC AMC in terms of growth? Will it be higher than India's GDP, higher than India's nominal GDP?
No, I think given the under penetration, and then we are, as I said, that we are so lucky that we are in this industry at this point in time. We have got funds which have got a track record of 30 years. Build the organization, all the people that who have been part of this journey. I've joined like a couple of years back, but so many people who have been part of this for over 25 years have built a scale with quality and profitability that on this base, the foundation has been laid. And over the next 10, 20 years, I think if we remain true to our mandate and true to our vision and mission, I think sky is the limit. As I said, that you can go back and check what the AUM of US asset managers in 1980s and where they are today. They are managing trillions of dollars. In a $20-30 trillion economy, would there not be an asset manager in India who would be managing that kind of money that global asset managers manage? I will be surprised. But interestingly, the mission we have put for ourselves is to be the wealth creator for every Indian, and that's the joy. That in next several years, it's not about the AUM or the equity AUM alone, but it's about how many more households that we can reach and how to ensure that the growth of the country is taken to every household. And the vision we have set, and that may sound very audacious.
This is HDFC's vision.
AMC,
Okay.
SDFC AMC. This is the mission to be the wealth creator for every Indian. And the vision we have put for ourselves, and this may sound very audacious, but we genuinely believe, and all of us are committed to it, to be the most respected asset manager in the world. I mean, we are part of a group which is synonymous with trust and confidence. People look up to that name and have so much of respect for it. Over the next 20-30 years, as the country grows, as capital markets grow, as asset management industry grow, within that our growth is given. But the real joy will be world over, people will see an asset manager, how we build that trust and confidence, how.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.